Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Pierre, Senior Manager and Mentor. Welcome back, Pierre.
Well, thanks for having me, Mark.
How are things going with the IRS lately?
So the IRS is in a little bit of a pickle because, as we've talked to a number of times about this, all their work has been piling up while they were shut down. When the current administration came in, they released a lot of the employees. They put a lot of people on furlough when they had that oversight committee going through all the entities.
That was Doge, right?
Yes,
yeah,
Doge. So there were a lot of people that took the early retirement incentive. And so you had a lot of knowledge leaving the IRS. And
a big brain drain, right?
Yeah, brain drain. And then they went on the government shutdown, the government vacation, where I think, Mark, you just pointed out that all the tax returns, all the processes still went on, but there was nobody there to do it. So you have a bunch of new people, you have less staff, new people, and we're now way behind. So that causes a little bit of a glitch for the IRS. Same thing happened during COVID when they had to send people home. All those tax returns didn't get COVID, but people did.
That's hilarious. These tax returns didn't get COVID. They were still coming to work.
They were still coming to work every day. I know, but all that work piled up, and I don't think they've still recovered from that.
So I think one thing that we kind of know, and we've mentioned this before, is that, hey, just because you've done something and there wasn't an issue doesn't mean that it's not coming.
Sure.
It's just they're that behind. So now instead of waiting weeks, months, it could be years, but it's coming. So let's talk about these major triggers, like the things that we need to watch out for when working on our taxes.
Yeah.
That the IRS is looking at. Yeah. And these things are changing.
Yes.
We were talking before about a form that wasn't an issue before, and now this year all of a sudden the IRS is very interested in it.
Yeah, like the form is the answer to everything. But when I talk about the big picture on here, what we have now going on in the government is data matching. Data matching has always been available, but they weren't very good at it. But with the lack of people, lack of resources, lack of experience, they have to rely on mostly using data matching to find out if you're not reporting your income.
Please explain that.
So
a little bit, what
think
data
of
matching is.
Data matching is your W-2.
Okay.
The IRS has for many years done a great job of getting the W-2s and matching that W-2 should be on your tax return. Mm-hmm. So if they have a W-2 and you don't, they're going to give you a call, right? Mm-hmm. But they've done that for years because all individuals, generally, not all, but most of them have a W-2, and that's an easy way for them to catch if you're not reporting stuff. Okay. So now the IRS was not very good at matching a K-1 from a company.
Okay.
K-1 is what the company, if you own an S corporation, it says, I made this much money during the year. You have to put that income on your tax return. The IRS was not very good at matching that to your tax return. Mm-hmm. Now, over the years, they've gotten better. And with the lack of knowledgeable people in there, they have to rely on computers, which they've always done, but the computers are getting better at matching that information. Okay. So it's not like somebody's out there looking for you or using their spidey sense to pick you in the audit. Mm-hmm. It's a computer software that's saying, hey,
we're missing something.
This person, this owner of this company is not picking up that income, or they picked it up wrong, or they took too much in activity on that return that isn't on their tax return.
So it's looking. They're relying more on computers and looking for these mismatches. These are the big triggers that you're seeing.
Yeah. So a lot of times people think it's if I have a lot of income, I'm going to get picked. Mm-hmm. There is a little bit of some ideology that says if you're a bigger fish, they're going to look at you more, right? Is it worth going after somebody who doesn't have much income? But it's not just about income. Mm-hmm. If you are not, we're all supposed to follow the rules. It's what can they find with their limited resources. Right now, less than 1% of all tax returns get audited according to the IRS's own data information. Mm-hmm. But so you really have to do something wrong to find out or get caught. And one of the ways to get caught is if you don't report your W-2 and your W-2 that you worked at a corporation, you make $30,000 a year, and you don't put that on your return, you're going to get a call. It doesn't mean you're you're definitely going to get a call, but they're probably going to send you a notice, because a lot of it, they don't call you so much. They'll send you a notice and say, hey, we changed your tax return by this $30,000. Okay. But if you do that with your K1, that's $3 million. Not only are you going to get that, they call it a paper on it. They're going to say, you know what? I think there's a little more there. Now that you messed this up, let's go look at more of your stuff.
And the reason that they're doing this isn't because they just want to pick on you. It's because they know over the course of history, okay, this means something.
Yes.
This trigger likely leads to this, that leads to this, leads to this. And again, a person who isn't doing this likely hasn't been doing this before. So again, they're not picking on you. It's just they know, okay, we busted you for this. It's likely you've done it before. And just like with any other crime, it's you've done this crime before, you're far more inclined to do it again. Once you've already, passed that
Cross that line.
Yep. That's exactly it. So
and I think as you had pointed out before, they might not have caught you on that one from 2 years ago. So you're like, hey, I did it that year. Let me do it this year. But now they're catching up to you.
Yep. And they will eventually catch up. I see right here, income mismatches. You mentioned crypto.
Yes. So there, again, we talk about getting better. Crypto is a very volatile, unknown area, but it's new to them, so they're trying to learn it. So they're putting in ways to find out that mismatch. So they might not know some old rule. They're not concentrating on the old stuff because it's not as big, but crypto is a big dollar amount. And so they're trying to find ways to get that information to them to do the matching.
See, and it's interesting too, because, when you're moving stuff in the crypto market, you don't actually get something until you take it in, or till you take it out. So a lot of people who deal in crypto they'll put the money in, they will make, lose, whatever. Yeah. Again, it's a very volatile market. You may not get something until you take money out.
Yeah.
So even though, let's say you put in $5,000 this year and you don't take anything out for 40 years, that's when you need to start reporting it. That's the concern.
Well, that's what people think. However, you take that crypto and you go to McDonald's and buy a hamburger with crypto money. You've taken that earning. Yeah.
That's right.
So that little piece, say one McDonald's cheeseburger doesn't make the difference, but if everybody in America does it, it's a big number. And the IRS is trying to learn how to track that. And that's why there's so much scrutiny on it, because it can be a big piece that we don't think about. So many times my clients are like, he's not going to give me a 1099 for that, so I don't have to report it. And I always say that is not the rule. Well, a lot of people do that.
So what
but
you're
that's not
saying
the rule.
is potentially people are able to dodge taxes by buying stuff with crypto.
Yes.
Okay.
But the IRS they're aware of that. And they're trying to figure out how to catch it. That's why there's so much scrutiny on it. And because it is electronic, if I buy your surfboard from you off your car, there's no trail. There's no trail that you just made money on that surfboard that you made for yourself. But in crypto, there's a trail.
There is. Okay, so let's get into what deductions tend to raise the most red flags.
Yeah. So for individuals, we look at things where there's a lot of leeway. Office home deduction, charitable contributions, and I think we have on there vehicle expenses. That's stuff where people think I can make it up.
The vehicle expense we've talked about before on this podcast, and yes, there's been a ton of leeway on that. So yes.
So, but the IRS knows people tend to fudge it. So one of the things I talked to my clients about, because a lot of people don't keep records, but there's a lot of good software that you can keep great records on your phone. You don't even have to write it down. You just pull it out of the summary at the end of the year. But number one, don't tell me your vehicle deduction is 50,000 miles or something. That's a lot of miles to drive, right? It could be, but you better be going from New Hampshire to Florida
on a
once a week or something like that. You can't, if you work here, it'd be a lot for me to take that kind of deduction because I live 8 minutes from the office, right? So that's my commuting, but I don't even have that many miles from that. All my other miles are going to visit family and stuff, but if I'm doing it for business, let me see, the miles on my car was 20,000 last year and it's 20,000 this year. I think half of it is for work. Let me just say 10,000 miles. Put that down. The IRS says, okay, 10,000 miles, is that reasonable? And they just have a computer doing that look. They don't judge it They don't have somebody saying, there's no way, like, here's his house, here's his office, or anything like that. They say, that's a lot of miles. We need to go look at this program, look at this taxpayer. And on our software, it will say, it's a little hard. The classic example is here in Northern Illinois, our real estate taxes are pretty high.
Yep.
So I get a little diagnosis that says, real estate tax is high for your income. And every time I say, yeah, I know.
Thank you for
Thank you for pointing that out.
Yeah.
But it's because they have tables that say, if you're making this much money, you should be paying this much in real estate tax. But it doesn't adjust for Northern Illinois. Your real estate tax on a normal home can be $10,000. Same house in another town on the East Coast is only $3,000 for the same $300,000 house. Yep. And it doesn't have that ability, but it says, here's the grouping. So charitable deductions, home office, and vehicle expense. Charitable deductions, classic. People think they're giving away stuff that's worth more. They don't keep receipts. If you don't have the receipts, the IRS will not allow you to take that deduction.
And again, the big thing is, besides, again, the receipts, it's the out of proportion. You cannot be making $20,000 in your business and be trying to write off $15,000 in loss or in donations, where that is clearly an issue.
That is a great point, especially because that scenario can happen. If you're retired and you work weekends at the library, and you just do it because you like being the librarian, and you make $15,000 a year, but your family has a lot of money, or you invested your whole life and you have a lot of money, and you have to give away because requirement of you could be in that scenario, but that's the exception. You're absolutely right. $15,000 company should not be giving away.
Someone in their 30s or 40s who's working, has a family, they can't be doing that.
Yeah,
it's pretty clear something's off.
Yep.
Okay, so why do small business owners kind of face a higher audit risk? I think I already know the answer, though. Because they have done the bad things,
yes,
right, historically.
So as a group, historically, they've taken advantage of putting personal expenses on businesses. So when you have a board of directors and investors involved, there seems to be a little higher scrutiny, or belief that there's higher scrutiny that you're not misspending your funds.
Right.
When you have a Schedule C, which is just you as a business owner, you're not incorporated or anything, a sole proprietor or something like that, you're the shareholder, you're the business, or you're the investor. So maybe that trip to to get some parts at the hardware store to repair your machine, you also picked up laundry basket, soap, other things that you can get there that are personal and not deductible, and you paid for it with the company car. So there's definitely some room for error.
I'm going to run a little simulation past you, okay? Your house is your business, and sometimes clients come to your business, and part of your house needs to get repaired.
Yes.
Front door, for example, which your clients would walk through every day.
Yes.
What would you say for a deduction on that?
So remember, deductions are ordinary and necessary, okay? I think you do have to have a front door.
I do believe a front door is essential.
But the IRS, if it's the main door for your house, like the only entrance to your house, the IRS is going to say, you didn't use this for 100% for business.
It's true.
All right. But if you had a side door into an office that was part of your house, or it came into the main house, but you went right into a room, and you had the name of your business on the front, and only people came over there who were going in, like you don't go in that way to bring your groceries in every day. It's kind of out of the way to do that, but it's on the side for the business. It's very hard for the IRS to say that's not a business expense.
Makes perfect
sense. But you have
sense.
one door, that's the only way you come in after you've gone to the Bears game last weekend, you're coming through that door. That's not a business expense. So while I do believe some people will put the whole door repair on their business and just say repair, some people will get away with it, and they got away with it last year, so they're going to get away with it this year. That's where people get in trouble. And the IRS knows that, and they know it's susceptible to having that mistake. You think, one door. Okay, yeah, that's true. But then you do the door, then you do the garage door, then you repair the swimming pool, then you get a swing set out back. It's a creep kind of feature.
Well, and to add to that, you're still like, okay, you get a new door, for example. There's still, you get tax credits for energy savings, all that other stuff. So you're already getting something.
Yeah, you're double dipping too there. Yeah.
So that, I'll just say, probably another red flag, right?
Yes.
Hey, this is for my business, and I get energy savings. So things to watch out for.
Yep.
All right, so let's kind of wrap this up. What are the biggest misconceptions that people have about these about audits?
So the biggest one I think I alluded to earlier is there's not a person going over your stuff and looking at it. Although if you get it into a person's hand because you've done an amended return or you have a mistake that they can't figure out, now a person is looking at it. And that might trigger something, but most likely it's the mismatch of documents is going to trigger an audit more than anything else, more than an agent randomly picking your stuff out of the pile. Because remember, they can only do 1%. Not that they can only do it, but their capacity is less than 1% of all returns.
So, and this mismatching, like I said, hey, says you have a W-2, we don't got one.
Yeah.
Hey, there's a K-1, where is this?
Yep.
And that's it. And honestly, that is very basic stuff.
Yep. And the biggest one is the 1099s. We all get a W-2 if you have a job. 1099, some people give it, some people don't. The IRS is making companies and businesses and tax preparers produce. There are penalties for not giving you the 1099, and that's trying to close that tax gap.
Yep.
Like when I buy the surfboard from you that you made out of sticks and mud and dirt, and you sold to me for $1,000, you should be giving me a receipt for that. Or if I'm buying it from my surf shop, I should be giving you a 1099 for buying it from you if you're not incorporated.
Wait, isn't the minimum number like $2,500?
For 1099s?
Yeah.
Oh, for materials, yes. Okay. But I hired you to sculpt it for me.
Oh, okay.
Not just the material. It's a great point.
Okay. I just want to make sure.
Yeah, that's a good point.
My surfboard shop that
the surfboard shop, yeah.
On top
that
of
is
my car.
not incorporated
Yeah.
with 50,000 miles.
Thank you, Pierre.
You're welcome.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.